Uh, yeah, we can get started then. We're we're starting this meeting as like an introduction to blockchain series. So like anyone that just maybe wants to get involved with the club, maybe new to the topic of blockchain, we're gonna do a series of meetings that we're starting with trading because it's what like everyone kind of hears about, knows about, and then like based on attendance and what the like audience is of people, how new they are, what they want to do. We can continue with these kinds of meetings on like other topics in the like blockchain ecosystem, or maybe go more in depth, just whatever people are feeling. Um, and some of the future topics are just stuff like centralized exchanges, smart contracts, stuff like that. Just key components of the blockchain world. So just for this presentation, I'm going to start with an introduction to the volatility, the price swings, the nature of crypto markets and crypto markets versus traditional markets, and then I'm going to go over why these tokens actually have some real value, the purpose of the tokens, and then end it with a little bit on trading. Okay, so the introduction. What's going on? So if you look at Bitcoin and Ethereum and you compare them to a couple of traditional assets like the S&P 500 and gold, you can see that there's major differences in the returns going on, at least in the recent history. If you look at 1 year, 5 years, 10 years, and then it's like up 37,000%, up 1,500%, and then even the S&P is up 1,000% in the last year, and gold up 26%, up $1,000. My bad. Up 15%. Oh, I messed those numbers up. I was reading the wrong ones. But you get the point. I couldn't get the same picture for these two, but you can kind of see the idea. And then like 10 years ago, S&P 500 is up 161%, while Bitcoin's up almost 20,000%. So it's kind of it's by nature a pretty different market, and you see different and you see that reflection in the prices. So this is just another way of looking at it, and this is you can see in much shorter time frames. So it's quarterly returns on Bitcoin and Ethereum, and I mean just looking at it, you can see like price swings of 100% in a quarter, 40%, 17%. I mean it's super rare you see anything on this that's a change of like less than 10% within a quarter. And then look at the averages also, and then it's just on average. And these are the two biggest crypto assets, and they're changing 50%, 27%, 90%, whatever it is. A bunch of changes of more than 50% in just one quarter. A bunch of changes of over 100% in a quarter, and you can really get to see the crazy volatility of these assets in the different time frames. And then if you really want to see some crazy volatility, you get to meme coins and stuff like Joe Biden coin, which is, it's just someone made this as a joke for fun, and then it's like up 160,000% in 1 month. And this is just like the most recent hype, and you see something like this happening, and it's like, okay, where does this coin exist? It exists in the Solana's blockchain ecosystem. It's built on the Solana blockchain. It exists in that world. You won't find something like this listed on Coinbase. In order to buy this, you need to actually get into the process of using a blockchain. You need to create a wallet, use a decentralized exchange. You need to purchase Sol, swap it for Joe Biden. But even with all of that, you still see this gaining a ton of popularity. And then another example, Dogecoin. I think everyone's heard of this now pretty much. Or you hear a crypto and someone's like, oh, what, you buy Dogecoin? And then it's like, okay, you really see the power of the meme driven hype in these rallies. And it's like when Elon Musk's tweeting about it, and these tweets have 190,000 likes, 200-something thousand likes. It's like a stupid amount of people are seeing this. And then there's just that many people that are fans of this guy, and then you can see the actual results of his tweets and how they change the market. And these are just swings in hype, and then you really see the reflection of that in price. And then like the other interesting thing is, it's someone that famous, and like right when he started tweeting about it, the coin had a market cap of less than $1 billion. So it's like, it doesn't take that much of an inflow compared to some of the other coins for there to be like massive swings in its price. And then the interesting thing about it that you can see on this bottom graph, which it doesn't completely cover the life of the coin, but it was created in December of 2013, and it really got famous when like Elon started tweeting about it. But Dogecoin was the very first meme coin. Dogecoin is a fork of Litecoin, and Litecoin's a fork of Bitcoin. So because the code for blockchains and the software is all open source, everyone has access to it. So people who made Litecoin, they made it up based off of the original code for Bitcoin. And then people who made Dogecoin, these guys who just made it as a joke, kind of mocking cryptocurrencies, they took that Litecoin code and forked it to come up with this. And then you see, become super famous a little under 10 years later. And then, so those are like big swings upward, but like not everything is super positive in that way. Like if you're buying a Bitcoin, if you're buying these currencies, you're going to see crashes like this. And so like if you compare Bitcoin's crash in 2021 to the S&P 500 and the most like famous crashes of the S&P 500, it pretty much beats out all of them, except you could say COVID was worse. But I mean, COVID did rebound really quickly. But it's like, Black Monday, which is supposed to be like the quickest, fast, like most, it's like the fastest crash that the stock market's had. And 2021 Bitcoin crash beats that out. And then these other crashes, like you can't even compare to how quickly Bitcoin's price dropped. And then like you look up here, and this is from a while ago, like 2013, 2012, the price of Bitcoin, and you see in 3 days it drops 57%. In like a little over a year, it drops 87%. In 3 days, it drops 83%. But like the other interesting thing about this is like this is 2012, 2013. Like, very few people even heard of Bitcoin. So like imagine you're someone that finds out about this and you're like, whoa, this is really interesting. I think this could be something worth putting a lot of money into, and no one else knows about it. And then its price drops 83% in 3 days, and you're like, okay, how much do I really believe in it now? Really test that. And then you see the same thing happen with meme coins, where it's just, the price of something like Pepe coin, where it's like, this is just, something almost meaningless, but like, just like there's a increase of 160,000% in a month for Joe Biden coin, it usually eventually falls off like that. So why do crypto markets like act this way with this crazy volatility? One of the things that has a really big factor that plays into it is the combination of memes and social media with crypto markets. We have a really fast way to propagate information from people to people around the world that never existed before. And then you combine that with the fact that all of the crypto stuff is very digitally native, which is unlike traditional markets, which you won't see it's much less common to see someone doing very detailed financial analysis of a traditional market asset on Twitter versus most of a lot of the people that do that for crypto stuff, they just post it on Twitter to their followers, on YouTube, on Reddit, stuff like that. So this kind of information propagates a lot through those channels, which are also related to a lot of hype cycles of driving these trends and those kinds of things. And then it's like someone like Elon tweeting this out that has its effect, and then these narratives get formed that way, and they rise and fall really quickly, and then stuff like something like a meme, like a dog with a hat, becomes a coin that has a crazy market cap and a lot of people buying it and a lot of people trying to make money off of it. And this kind of virality is really impactful for meme coins especially, but you do see it in stuff like Bitcoin and Ethereum too. Another reason that the markets act this way is if you look at just the market caps for these coins and these assets and you compare them to traditional assets. So if you compare the top 10 coins, and this was as of a few days ago, to the top 10 publicly traded stocks. So Bitcoin's pretty comparable, but then you go down the list and all of these top 10 publicly traded stocks would be top 2 in the crypto markets. And so you just look at the 10th, you look at Avalanche, and it's like that's 17 billion, I'm pretty sure. Yeah, 17 billion. Like that doesn't even come anywhere close to the 10th highest publicly traded stock, which is at $700+ billion. So the top of the market is nowhere near equivalent. Additionally, what I don't have on this slide is the bottom of the market is also nowhere near equivalent. Anyone can make a meme coin. Anyone can start their own blockchain. And then that means you can have a ERC20 built on top of Ethereum that anyone can make and anyone can trade, can have any amount of value. And because there's that lack of friction to creating coins and creating tokens, just much more of them are going to exist. Creating or having a publicly traded stock, you have to go through a set of regulations. You have to go through, it has to be sold through a brokerage. There's all this additional friction that there's just going to be much less of them. You compare them to, meme coins or shit coins or something like that, the very bottom of both these markets. And then, meme coins can be like equivalent to a penny stock. But if you combine the volatility that already exists for a penny stock with the virality of the crypto trends and the way the narratives change so quickly, and additionally with the permissionless trading that you have in crypto, where you don't have to operate through a brokerage. There's no set times a day that you can only operate within. It all compounds to make even more volatility in these markets than in traditional markets. And like I just mentioned, permissionless trading and markets with no real handicaps are a really they're a feature, and also I guess you could call it a bug too of crypto markets, but it really is part of the central thesis of blockchains and the crypto world. And so bringing this up, I wanted to explain what happened in 1987 on Black Monday, which I think it gives some context to why traditional markets may not move as quickly. So if you look at Black Monday, the Dow Jones dropped 22.6% in one day, which that would never happen now. It's not even possible. And the reason that a lot of people attributed that crash to happening so quickly and accelerating so fast was because something that was new at that time were these things called portfolio assurance hedges. And basically what those were these computer programs that automatically traded on futures and calls and puts. So when a stock price would drop to hit a certain number, a stock that someone owned in their portfolio, they would have these computer programs running that they would automatically hedge against their portfolio just to decrease their losses. But what that did is it kind of just made this insane drop where the market started falling, and it kept on falling because these programs were just automatically trading and pushing prices further and further down. And so in the government's eyes, that automated trading got out of control. And so what they responded with was a set of regulations that they're called trading curbs and circuit breakers. And basically what those did was there's basically different benchmarks where these different rules kick in, the trading curbs and the circuit breakers. And what they're doing is they're temporarily halting specific types of transactions with futures and calls and puts to prevent these kind of really large price declines. And so that if you look at that, that's what really, even because traditional markets are traded a lot very digitally now, but crypto markets don't have any regulation like that. Once a price starts falling, there's really nothing you can do to stop it. There's no market restrictions, and that's because the inherent property of blockchains that it's all open source code basically, and all these applications to trade in this stuff, it's all open source code that anyone can run on their own, and most of the time on your own personal device. So that means you can at any time transfer, sell, buy coins, and really no one can stop you unless they take away your computer, take away your internet connection. So then the markets are obviously open 24/7. They don't have the same regulation that you find in traditional markets, and Additionally, you have the restrictions in traditional markets of stockbrokers and the regulations and those kinds of restrictions that you don't have in crypto markets. And crypto markets have the seamless ability to buy and sell because it's all natively digital, and that kind of amounts to these really quick rises and falls because there's nothing holding the marketplace back. Okay, and so now that we've covered all of this about the markets and the volatility and some of these tokens and coins, a logical thing to wonder next is why does any of this have value in the first place? It seems like so much of this is just about trying to make easy money off of buying and selling random coins based off of hype and these kinds of things. But it's what's the purpose? Why do they exist? And is there any real value behind some of these things? And so I'll go over a few different aspects that I think lead to there actually being some underlying value. And the first is that tokens are the representation of ownership in blockchain networks. And so the current way that most of the digital world works is that it's these companies are corporate networks where it's basically they control everything. The people who run the company, they get to make all the decisions. They get to take things away from you. They get to keep it. It's all under their own control. And the purpose of blockchains really is to spread this out to where everyone that's a user of the network is also an owner of the network. And then they as a collective, they get to be the ones that control and run the network together. And to be able to do that, tokens kind of fulfill that ability. Tokens allow for ownership that this kind of ownership is really present everywhere in our physical world, which if you compare the way the physical world works to the way the digital world works right now, it's if you own something in real life, in the physical world, you're not expecting someone to come and take it away from you or be able to do that or have that control over it. It's you own that thing yourself, versus in the digital world, there's really very few things. There's domain names or a website you can put up, which are things that were created many, many, many decades ago before the internet was really popular. But everything created in the last couple of decades, everything you have on the internet mostly can be taken away from you, and you don't really have ownership or control over it. And so that's something that tokens do, where your tokens are true ownership because they can't be taken away from you. You can only give them away if you own them. And so unlike corporate network, there is no certain corporate networks. There's no certain group of people that can make whatever decision, make final decisions in this network. And this kind of digital ownership wasn't possible before things like blockchains and tokens allowed for it. The next thing that I look at as a thing of value is for tokens is governance. So owners of tokens in a network usually a lot of different networks have proposals for improvements or new features or whatever it is, and because you're an owner of this token and you're a member of this network, you get to have the voting ability to decide if you want new things, if you want to improve it, if you don't want it. Adding new features, and for something on Uniswap, you can vote on fee changes, price changes like that for doing certain actions, and it's kind of the way that your control, your ownership of the network gets enacted through governance. And in order to do that, you need tokens. And the last thing I'd say is incentives. If you're an owner of the network, you need to have some incentive in the network growing, the network having more utility, or the network becoming better. And tokens are kind of what enact that. So the value of your token is a direct incentive to improve the network and improve the utility of the application or the blockchain that you're a partial owner of. So that's kind of my third thing that I think is really, really important to understand about tokens. And then now this last section of the presentation, I wanted to focus on trading and why kind of just I guess your like intro guide to trading. If you're already involved, you want to get involved, it's kind of for you. How you get some charts looking like that. Really briefly, you need to understand the difference between centralized exchanges and decentralized exchanges. So, a lot of people have heard of Binance, Coinbase, Kraken, which are all centralized exchanges. Those companies themselves hold the coin or token or whatever you want to purchase. You don't hold it yourself, and which that means basically when you give your money to this service and say you're buying whatever coin or token, they have some database that stores your name, and it's just a regular database, like a database that every company has, and it stores your name and the value of whatever token you have corresponding to your account. You own X amount of Y token or whatever it is, and then the centralized exchange also has to decide what tokens and what coins they want to list for people to be available for people to purchase. So that makes a few more restrictions on trading, where the centralized exchange has certain things they have to think about. Like, they may be worried about listing certain tokens based off of how the regulators or the government or whoever it is may perceive the services they're providing. And then they may also, an additional thing is they have to provide the liquidity for you to be able to purchase these tokens. It is really like a black box. So in reality, they could say you own something and they themselves are holding none of it. But what most of them do when they're acting honestly, the centralized exchanges, is they have to own some amount of this token to provide liquidity to people who want to purchase them, which that's an additional risk that they need to maintain when they're holding whatever random meme coins that they jump up and down in price really quickly, and the amount of people trading them jumps up and down really quickly. And additionally, for every additional coin they list, that's extra infrastructure, extra like computational infrastructure that their company needs to maintain, right? So it's like additional servers and all of those kinds of things. And since there's an infinite amount of tokens or coins that can be traded, it can get to be pretty expensive to try to list everything. And then if you compare that to decentralized exchanges, you have stuff like Uniswap, SushiSwap, and basically those decentralized exchanges make a framework for multiple users to trade and swap some coin between each other, some coins or tokens. And there's no regulatory body here, except for, I guess, all the owners of the token who get to vote on like governance proposals, which anyone can be a part of. And this is all like open source code that people can run. And anything can be listed as long as people are willing to provide the liquidity for it, which then makes another market in itself, where if someone thinks that they can get returns off of being the one to provide liquidity for that market, they'll do that, and that's how it usually covers a much broader ecosystem than a centralized exchange can. And then next, wallets. In order to really trade, you need to have your own wallet, and so there's hardware wallets like Ledger and Trezor, which they're cold storage, they're offline. And then so basically these wallets also, they store your public and private keys, and that's how you access whatever coins you own. And then your wallets, what they also do is they can sign transactions since they hold your private keys, and they interact directly with the blockchain, unlike your account on a centralized exchange. And then additionally, there's software wallets like MetaMask, Phantom, and these are like online, so there's additional risks with them. But basically, what you need to know about wallets is this is where security becomes really important, because these are holding your private keys, and your private keys have direct access to your funds. So if anyone gets a hold of your private keys, you're screwed. There's nothing you can do. They can take whatever you have. That's how simple it is. So whatever you choose, however you interact with it, you need to be really, really safe and secure with what you're doing. And then putting everything together. So you need to have your wallets and decentralized exchanges. You need to have some good charts like this. Maybe you won't even understand what it's saying, but it'll have a lot of lines on it. you'll need to understand narratives and versus like a true value of the ecosystem. You know, sentiment in all types of markets can be really blinding, and then especially in crypto markets where everything is so online, on social media and everything. Since the price swings can be so quick and so strong, then that also means the sentiment can really change really quickly, and the sentiment and narratives are really heavily affected just by someone posting on Twitter, right? So kind of balancing that in your head of what the true value of something is versus just what the narrative and sentiment of it is really important to think about. And then you can get your information from people like Kat on Twitter. Just have your right sources where the people you're listening to talking aren't like feeding you stupid shit. They're like, make sure they're actually saying, make sure what they're saying is truly like intelligent or just information in an unbiased way. And then just one more thing, always make sure to do your own research. You make sure to ask yourself, like, what problem does it solve? Is it a layer 1? Is it a layer 2? Is it a roll-up? Is it a side chain? And then, when you ask yourself that, or is it doing data availability? When you ask yourself that, you have to think about, okay, what's the market potential for each of these different solutions? And then, because those are the two things that are heavily related to each other. And then when you think about that, you also got to think about how strong the actual team is of people that are working behind this. Because you could have a really good idea, a really good product initially, and then you could have a really strong market potential. But people working on the problem aren't good enough, then it really won't go anywhere at some point. And then just one more thing to mention, which this is not directly related to trading and how we've been talking about it, but if you want to make like more safe long-term investments, people usually go with something like DCAing, dollar cost averaging, and the idea is that you don't need to time the market in something like this. What you do instead is you invest fixed amounts of money over like a decently long period of time at regular intervals, and then what you see the result of this is that the volatility of the market has much less of an effect of the price you're buying at. So you slowly increase the amount of shares that you own at buying at each of these points, and at the same time you won't have any issues of maybe buying up here at a higher point, but you also you lose the possible upside of getting some advantages if you do time it correctly. And then the last thing I'd leave it at is that Benjamin Graham, who's really famous for value investing and talking about traditional markets, has this quote that over the short term, the market is a voting machine, while over the long term, it's a weighing machine. And it's just like really something that's important to consider, that short-term price swings are more based on kind of like almost like a voting system where it's what people are kind of thinking in that moment, while in the long term, what really matters are fundamentals and the true market value of some product. That's the presentation. I did have one other thing. Our meeting times are kind of not ideal. Fridays at 4 maybe for a lot of people. So could everyone who's here today, if you could you raise your hand if you would rather meet at another time during the week that you think would be better? Is this difficult for some people? Okay. Well then, never mind. Not as many people thought that as I'd think. So this was, okay, then you can disregard this. This was just to see if there's possibly a better meeting time during the week for people. And yeah, that's all. Thanks for coming. We have some food in the back. We're going to keep on doing the weekly meetings, probably every Friday at 4 still then. A variety of topics. If there's stuff you're interested in, make sure to talk to like me, Alan, Dylan, and we can try to figure out what's best for everyone. Yeah, thanks for coming. Rohit, do we have plates or no? I saw the thing you put in the Discord about StarkNet. Uh, oh, one more last thing, guys. If you're not